Welcome to Chapter 10, which is about banks and the credit market. This chapter talks about a lot of things, as all chapters in the core textbook do. They talk about how credit markets facilitate consumption and saving, how conflicts of interest and information asymmetries characterize credit markets. It talks about what money is and what it does for an economy. It talks about banks as profit-maximizing institutions. It talks about central banks and their roles in the economy. And it talks about interest rates, banks, and central banks. And finally, it talks about inequality and credit markets. So like I said, there's a lot going on in this chapter. All right. Why are banks important for economies? Well, first of all, they provide credit for businesses and households. And secondly, they hold deposits in a secure location. So they provide an alternative for people who might be inclined to store all of their savings in their mattress, etc. And then another important thing that banks do is they contribute to the money supply of the economy. And when we start talking about central banks, we'll really get into that in more detail. Well, what is money in the first place? The textbook definition of money is that it's a financial asset that is easily accepted in exchange for other goods, services, or financial assets. Well, how does it function in an economy? First, it serves as a medium of exchange. Having money allows people to exchange money for goods and services rather than engaging in barter. Second, money provides a store of value in an economy. So if I receive my income in the form of money, I know that next week I can use some of that to buy goods and services. Some forms of money are better at storing value over time than others, and the general value of this comes in the knowledge that you can spend now or in the future. Imagine a society that uses something perishable as money. So imagine using something like cookies as money. Well, if a cookie falls apart in a month, that means that you have an incentive to spend that cookie in the period of time that it is still recognizable and in that money form. And then finally, money serves as a unit of account. If we think about prices as a measure of value, and price and value are not exactly the same thing, but we tend to assume, all else equal, that two goods of different prices may reflect different value overall. We can ignore wealth versus income, but broadly speaking, wealth refers to assets, total assets accumulated over time. The income that people earn over time accrues towards their wealth, but you may have wealth independent of your income. You may hold your wealth in a combination of money, physical assets, and financial assets. And broadly speaking, wealth provides a cushion for people in an overall overriding economic circumstances. Expenditure, savings, and credit markets. Money is important because it enables expenditure, but when we think about credit markets, we are also going to think about saving and how credit markets provide a venue for saving. Think about consumption. We assume that people use disposable or after-tax income for expenditure. Savings is the portion of after-tax income that you do not spend or that any given individual or household does not spend. Investment expenditure refers to spending by firms on physical capital, to spending by households and firms on property or real estate, and it does not refer to spending on financial assets. In fact, it is savings that are assumed to capture people's acquisition of financial assets. Assets, liabilities, and net worth. Balance sheets, which are the common tool used to map banks' holdings, have two sides. The first side, assets, relates to claims to future income, while liabilities relate to future obligations to pay. Assets include any interest earning assets and fee income, again, if we're talking about banks, while liabilities tend to include deposits from customers, which a bank is going to be obligated to honor in the event of a customer wanting to withdraw cash from their account, or to other loans and obligations that a bank holds. Net worth is going to be equal to the difference between overall assets and liabilities.